Dr. Joel Mendez was a wealthy cosmetic surgeon who operated a network of dermatology clinics across the Philippines. In 2003, Mendez paid for massive advertising campaigns in national newspapers like Philstar and The Inquirer, alongside expensive commercial rentals and frequent foreign travel. Despite these costs, his tax return for that year declared a net loss of just under 39,000 pesos. The Bureau of Internal Revenue flagged the discrepancy between his spending and his declared income, leading to criminal charges for tax evasion involving millions of pesos. The case reached the Supreme Court en banc, which affirmed a prison sentence of 1 to 2 years for the doctor's failure to provide accurate information in his tax returns. However, the court reached a different conclusion regarding the 3.6 million pesos in evaded taxes. While the prison sentence stood, the court refused to order Mendez to pay the civil liability. This outcome challenges the standard legal intuition that a criminal conviction for evasion should automatically result in the recovery of the evaded funds. The Supreme Court settled this specific point of law by looking at the internal structure of the tax code. The Mendez decision reflects the specific structural logic of Philippine tax law. It highlights a structural difference between the revised penal code, which governs most crimes, and the National Internal Revenue Code, or NIRC. To navigate modern tax litigation, practitioners must account for this divergence, which allows the state to imprison a taxpayer while simultaneously losing the right to collect their debt. The defense initially challenged the jurisdiction of the Court of Tax Appeals, arguing that the tax deficiency was an estimate rather than a final proven figure. Under Republic Act 9282, the Court of Tax Appeals has exclusive original jurisdiction over criminal tax cases only if the principal tax claimed is 1 million pesos or more. The court ruled that criminal informations require probable cause, not mathematical certainty. If the allegations suggest a debt over the threshold, jurisdiction attaches regardless of the final calculation. Investigators were forced to use estimates because Mendez ignored multiple formal notices from the Bureau of Internal Revenue to produce his accounting records. In the absence of these books, the state utilized the expenditures method. This method operates on a specific inference. If annual spending exceeds declared income and there is no proven source for the extra funds, that spending represents undeclared income. The BIR gathered third-party data documenting Mendez's commercial rent, his vehicle purchases, and international travel for their estimate. This allowed the state to secure a criminal conviction based on lifestyle costs, even though they never examined the defendant's actual ledgers. Mendez argued that the blame lay with his accountant, who he claimed concealed the BIR notices and failed to file the proper returns. This defense aimed at Section 255 of the NIRC, which requires the failure to file to be willful. The court addressed this by applying the doctrine of willful blindness. Willful blindness is the deliberate avoidance of knowledge regarding one's legal duties. For a business owner with the acumen to operate multiple clinics, failing to verify their own tax compliance constitutes a willful violation. Shifting administrative tasks to an employee does not exempt a taxpayer from the personal criminal liability of unfiled returns. If the state can prove the intent and secure the conviction, we are left with the question of why the civil collection still failed. Practitioners often rely on Article 100 of the revised Penal Code, which dictates that every person criminally liable is also civilly liable. This illustrates civil liability ex delicto, where the obligation to pay damages arises directly from the commission of the crime. Under the tax code, this relationship is reversed. The civil obligation to pay taxes exists by statute long before any crime is committed. The tax debt is not damage caused by the act of evasion. It is a pre-existing statutory requirement. A taxpayer becomes a criminal only because they failed to fulfill that prior civil obligation. Since the tax debt does not flow from the crime itself, a judge in a criminal case cannot order its payment without specific authority from the NIRC. Section 205 of the tax code provides that authority, but with a specific condition. The judgment must order payment of the taxes as finally decided by the commissioner. This means the government's right to collect in a criminal case is tied to the concept of delinquency. Delinquency only occurs after the Commissioner of Internal Revenue issues a final decision on a disputed assessment and the taxpayer fails to meet the deadline. In the Mendez case, the state established probable cause for the criminal charge, but they never issued a final, formal administrative assessment. Without that final assessment, the court lacks the statutory foundation to order civil collection, regardless of the defendant's guilt. This illustrates the different requirements for imprisonment versus collection. While estimates are sufficient for a conviction, a formal administrative assessment is mandatory to seize the funds. The Mendez decision confirms the severability of criminal prosecution and civil tax collection. For the defense, winning a dispute over an assessment at the agency level does not prevent the state from filing separate criminal charges. For the prosecution, a conviction does not act as a shortcut for collection. The administrative prerequisites must be completed in full. Tax litigation in the Philippines requires navigating two distinct procedural tracks, each governed by its own code and administrative requirements.